Welcome to the latest in the Fairer Finance Consumer Duty webinar series. I'm James Daly, the Managing Director of Fairer Finance, and today we're going to be delving into the topic of digital customer journeys. What makes a good customer journey? How should firms analyse their journeys? And how can firms use behavioural science to improve them? We'll also be looking at some examples of good and bad practice from across the financial services sector. And as usual, we'll be kicking off in a moment with a presentation led by my colleagues Eve McGrady and Tim Hogg, after which we'll move on into a discussion chaired by Eve. You can put any questions you've got into the Q&A or chat functions at any time in the webinar, and we'll do our best to answer as many as we can in the second half hour of the session. All the slides and a recording of the webinar will be available afterwards if you want to share with colleagues or just keep a record of our thoughts for some of your internal projects. So I'm sure if you're here today, you probably know who Fairer Finance is. We're a social enterprise with a mission to create a fairer financial services industry for consumers, as well as the businesses that serve them. And we do that by publishing our unique ratings, selling access to the data that sits behind our ratings through our insight portal, and by working with firms to help them deliver better customer outcomes. We also engage with policymakers and regulators and publish research reports to ensure we get the right balance of regulation and legislation to protect consumers without stifling business. Now, before we get to the meat of today's presentation, I want to give a very quick plug for our new podcast, which we launched this month and has been created very much with all of you in mind. We're releasing a new episode every 2 weeks, analysing the latest industry news and regulatory developments. And the first episode is available now and can be downloaded from wherever you get your podcasts. So we'd love you to give it a go. Let us know what you think and what topics you'd like us to discuss. We're hoping to add in a Q&A as we get going, as well as inviting the occasional guest onto the show. So if you've got a director or CEO that's interested in taking part, please do let us know. I appreciate that podcasts are not for everyone, but if you've got a dog or a long journey to work, they are great for dog walks and commutes. Okay, plug over. And on to the main event. What makes a great customer journey? Eve and Tim, over to you.
Thanks, James. So we're going to start with 3 key insights from behavioural science before Eve takes us through the applications to digital journeys. Let's start then with the bad news. We all have cognitive limitations, which sounds a bit harsh, but reflects the fact that we don't have brains the size of small planets. Our mental effort is a scarce resource to be rationed carefully. If I thought really hard about every decision, I'd still be deciding what to eat for breakfast. But thankfully, we have excellent ways of making quick and efficient decisions. With our emotional responses and rules of thumb, drawing on the information in front of us. However, this way of making decisions means that our choices depend on the way in which the information in front of us is framed. And this framing is called the choice architecture. And the choice architecture affects our decisions. And it's kind of predictable because we all tend to think in similar ways, which is why with behavioural science, more harm is foreseeable. And this is why we say that without behavioural science and advances in behavioural science, the consumer duty would have been almost unthinkable. Now, sometimes we hear people saying that their choice architecture is neutral, but sadly, there's no neutral way of framing information. Whatever you do, some information is going to be more prominent. The question is whether the right information is more prominent. So what behavioural biases might affect consumers as they go through your journeys, and are these helpful in nudging consumers towards good decisions? And it's also important to remember that while we can inform customer behaviour and nudge customers in helpful ways, we can't ever de-bias people because we're always going to be working within those same cognitive limitations. The second thing to say is that we're guided by emotion, and this is especially important for digital journeys. We know that the emotional reaction to different stages in the digital journey is really important for how people interact and behave. But emotions are not always a bad thing. Emotions can be really useful. They help us respond rapidly. The amygdala, which is the emotional center of the brain, lights up first, often when we see information we have to make a decision. And it guides us in terms of how much of our scarce cognitive resources to spend on a decision. And it helps us overcome our natural inertia But thanks to advances in behavioral science, we know that certain emotional reactions are highly correlated with our decisions. For example, the extent to which you feel anxiety is correlated with the level of risk you're willing to take when making decisions about financial products. So what emotional reactions do your journeys generate in your customers? Are these helpful in ensuring that customers make well-informed and good decisions? Again, it's not possible to de-emotion people. The role of emotion is always going to be there. The third thing to say is that we are information foragers. Academics have found that they can model how we search for information in much the same way as how they model animals foraging for food. In other words, we tend not to read left to right, top to bottom really carefully. Instead, we skim read and scan the choice architecture, looking for the piece of information that we're searching for, or trying to judge what the really important information is and reading that. This means it's really important to use clear signaling, signposting people to the important information you want them to focus on. And it's especially true in a digital environment where we tend to skim read more quickly, and studies show that we recall less information after reading it on a screen. So what information are your consumers not engaging with in your digital journeys? And could this cause them to make poor decisions? With that, I'll hand over to Eve.
Thank you, Tim. So before we get into the detail and a couple of examples, let's just take a moment to think about the regulatory backdrop here. So we know that the FCA wants firms to create journeys that deliver good consumer outcomes. The FCA has also said that firms mustn't exploit consumer biases, emotions, vulnerabilities, or play on the information asymmetry between the business and the consumer. So digital journeys are on the FCA's radar for the year ahead, and they have already zoomed in on credit as one example where some journeys may exploit behavioural biases. So, knowing that this is on the regulatory agenda, what can firms do to analyse whether their journeys deliver good outcomes for customers? Well, firms can start by taking a look at what a good journey looks like. So, good journeys will give customers all the information they need to make informed decisions. They'll also help customers understand the benefits and limitations of the product and any potential risks. They'll also present costs clearly, so both immediate costs the customer can expect to pay and future costs down the line. Let's now take a look at a couple of examples. So this first example is from the Capital One credit card eligibility checker. And this checker gives certainty over whether the customer's application will be accepted. It also gives them the length of the 0% periods they'll be offered, as well as the balance transfer fee. So clarity on approval for a credit card avoids that situation where the customer applies and is then rejected. This information helps the customer make a fully informed decision before they go ahead with their application. Here's one that takes a slightly different approach, telling the customer you're very likely to be approved. This is still helpful because it gives the customer some indication of acceptance, but what would be really interesting to test is what customers really focus on here. So do they see that 9.5 out of 10 and think that means 95% likely to be accepted? Or do they just focus on the words here, on the fact that they're very likely to be accepted? Tim, I'm interested to hear what you think of this example.
Yes, an interesting question about how the likelihood indicator here affects consumer decisions on whether to apply. Does it affect different types of consumers differently? It's sort of an empirical question that you could find out through testing it. But does this representation put off risk-averse people who might think that that little bar of grey there in the donut chart is them? Or does it encourage overconfident people who actually probably should think that they're in that little part, but still apply anyway? So it's a really interesting question that you could test in your journey.
Thanks, Tim. And of course, text and images and diagrams like that one aren't the only way to convey important facts about the product. So here we've picked out an example from Holloway Friendly, who've used a video to talk about their income protection product. And it's a roughly 4-minute long video laying out the key features of the product in a way that might be more engaging for some types of customers. So we know that people digest information in different ways depending on their preference. If you've been to one of our webinars before, you'll have heard a figure that we quote quite a bit. According to the National Literacy Trust, 16% of adults in the UK are functionally illiterate. So for that group of people, watching a video might be easier than reading a lot of dense text, a lot of information or a table. We also know that numbers can be off-putting for some customers. So a video in this case might be a good way to combat those possible feelings of anxiety that some people get when dealing with numbers. On the other side of the coin, of course, there will be consumers who prefer to sit and read text and digest it at their own pace. So really, it's all about providing options. Accessibility is about choice and giving the customer multiple ways of accessing the same information. Many journeys will also contain industry-specific jargon, so words that firms rely on, but that customers may not be that familiar with. And defining jargon at the point it's used in purchase and application journeys is another step firms can take to help customers make informed decisions. So here we have an example from a credit journey where the firm has defined dependence. Just a small caveat to note here that the grey text in that original journey, which you can see in the screenshot on the left-hand side, may be difficult for those with visual impairments to read. So firms need to be really careful of colour contrast issues and other accessibility concerns that can make text difficult to read. Here we have another example, this time from insurance. This is an example from Tesco's pet insurance quote journey, and the screenshot was taken last year. The journey looks a little bit different now, but we thought this would be a good example to show you. So the graphic from Tesco on the slide here gives applicants a good indication of how protected they are for each cover level, and the table you can see on the left-hand side gives a sense of how much customers could expect to be paid out for different incidents. Now, we do think this has been created with the best of intentions, but maybe there's more the provider can do here. Tim, what do you think of this example?
Yes, it is really useful information for the customer that a 2,000 cover limit is going to cover 87% of claims. But it might also be really useful for the customer to see how high claims can go above that. What's the top 1% of claims? What if that's over £5,000 or even £10,000? Some people might not be able to self-insure against that more costly risk. And as we know, insurance is typically most valuable when covering those things that we can't self-insure against. So maybe a little bit more information would be helpful again in making sure customer decisions are going to be even more informed, but we certainly liked this figure.
Thanks, Tim. So making those benefits and possible limitations of the product clear is another key aspect of helping customers make good decisions. And many providers in insurance and banking alike have been implementing these kinds of lists that you can see on the screen here, covering the product features and limitations. And it's quite a nice way to summarize, give a kind of quick overview of the product and can be really useful. So we think the image here works really well for a product page, but for that really complicated stuff, firms will need to go beyond this. So summaries like this won't always be enough to ensure customers have the best chance of understanding any of those kind of possible exclusions or special conditions related to the product. So using tools to slow people down during the journey and focus their attention on the really important or really complicated aspects of the product will be necessary. So in this example, we would want to see the interest charges drawn out in the application journey so that they're prominently brought to the customer's attention. Good customer journeys will also make costs clear. This is an example from the mortgages sector. And whilst people don't apply for mortgages using online journeys, they do compare rates and costs online. Some mortgage providers have started giving customers more information to help them compare the cost over the offer period alone. And in this nationwide example, you can see they've broken down the cost over 2 years, as well as the impact of adding the product fee to the loan instead of paying it upfront. Now, not many providers in the mortgage sector give this clarity over cost at the moment. So, Tim, what does the evidence show on whether people have enough information to choose the right mortgage?
Yeah, so the evidence from the FCA going back a few years, and this is pre-Consumer Duty, was that up to a third of mortgage customers weren't choosing the cheapest available mortgage for them, even taking into account all their preferences. Now, I think there are some questions about that study, and even if that is quite a large overestimate, there are still loads of people who are going to be struggling to make the best decision, even just based on costs, to find the cheapest mortgage for themselves. And so it's right to give them extra support. And what we really liked about this example was not only are the numbers added up, as lots will do, but there's also those boxes at the bottom. So green box saying lowest cost overall, and the other ones showing the additional cost in red of choosing those options. So that sort of color coding and assistance is really helpful for customers. They really appreciate it, and that's what we find in our consumer testing. And so we're looking forward to more of the market doing this sort of thing.
Thanks, Tim. And so another thing that firms also need to be able to do to understand what good looks like is to benchmark themselves against others in the sector. So it's really useful to be able to understand what other providers are doing well and not so well across a whole range of criteria. And the screenshot we have here is from our Insight portal, and you can find a whole host of benchmarking information in there. Our research team mystery shops hundreds of journeys and rates their transparency. And we also consider things like accessibility. So as part of this analysis, you'll see criteria including color contrast, font size, as well as all of this product specific criteria. So taking a bit of a step back from those examples now, how can firms take all of that and use it to analyse whether their journeys deliver good outcomes for customers? Well, like we said at the start, you should know what good outcomes are for each product. That should be your starting point. Then firms will need to take the time to map each journey the customer could go through. Then within those journeys, a good amount of granular detail is required to understand exactly what information customers see, how many screens they go through, and to map any likely timescales. So especially with those journeys that could span over a couple of weeks. So claims journeys, for example. Once you've got to that point where you have that level of detail, you can then start to pinpoint areas where there is possible sludge. You might also identify deceptive patterns where key information is hidden or not prominent enough. You can also then begin to identify points where you might actually want to add more friction to slow customers down and help them make an informed decision. So getting the right level of friction is really important when designing a journey. And that is something we are going to take a look at now. So here we have a framework based on some of the academic work out there on friction. And really, this is all about getting low enough friction for customers to make good decisions and setting high enough friction to help them avoid bad ones. In the bottom row here, you'll see sludge and deceptive patterns. These are somewhat subjective and can often be interchangeable. And I know Tim actually has an example of a recent experience he had that he felt particularly grumpy about, some unnecessary friction you'd experienced in a journey. So do you want to talk to us about that, Tim?
Yeah, absolutely. I mean, so we try not to get hung up on whether something is a sludge or a deceptive pattern. Both can be used a little bit interchangeably. People have their own preferences for that, but ultimately you don't want to be using either of them. We had some first-hand experience of a sludge this weekend in the Hogg household when trying to transfer a cash ISA. We found that our existing building society required a physical form for a transfer out, meaning that the really slick digital journey of the fintech bank we were transferring to still ended up with us having to, rather grumpily, I might add, print off and sign a piece of paper. It was a bit of a waste of time, it was a bit of a hassle, and frankly, it's an anti-competitive sludge because it makes me less likely to want to transfer my cash ISAs in future. Ultimately, this is a perfect example of sludge, right? It's slowing people down unnecessarily, making it harder to make good decisions. I was probably unreasonably grumpy about it, given the level of hassle. But if that's happening to lots of people all over the country, then it is something that should be a priority for firms to change.
Thanks, Tim. And here actually we have an example of kind of the opposite. So a firm using positive friction to purposefully slow the customer down to make sure they've considered the information in front of them. So this is from a pet insurance journey. And yeah, the provider is really slowing people down so they engage with the information they're presented with. So forcing the customer to engage with what's being offered. Are you happy to go ahead with your cover? Another example you see quite a lot in insurance, which is the opposite, is using long lists of exclusions where the customer is presented with all the things the policy won't cover and then has one box to tick at the end to say they're happy with that. This actually isn't really the worst example of this. There are many worse ones out there. But on reflection, we think the customer could just be asked these questions in the application journey if they're really important questions. Or if the provider wants to display these up front, they should get the customer to agree to the statements individually rather than having that one catch-all box. Data protection is another area where we see lots of interesting choice architecture. In this example here, we have the part in the journey where the customer has to choose how they want to be contacted. And firstly, this choice is actually hidden from the customer in a click to open box. So where it says, tell us if you'd rather we didn't contact you, the customer has to actually click into that to see the options. Once they have clicked in, they then have to actively choose to opt out of marketing from various channels. And we've also seen even worse examples in other sectors. So a typical one you see is where the provider has pre-selected some options, but not all, which can be really confusing. So for example, post will have a tick next to it, but none of the other options will. And there, the customer really has to overcome their default bias in this scenario and engage with what's being presented to make an informed choice. So like we mentioned, sludge and deceptive patterns are somewhat subjective and can be used interchangeably. But a useful benchmark to use is to think about the steps required to do something that's in the customer's best interests, but not in the firm's commercial interests. And a good example of this is cancelling an auto renewal. And the example we've laid out on the screen here is actually based on a real journey Tim went through to cancel his car insurance. Obviously, it's a good idea to test the customer's intentions, but there are several steps here which might be overkill, and you have to kind of ask the question, is this sludge? So Tim, is this a fair reflection of your experience in this journey?
The journey I actually went through to cancel the auto renewal on my car insurance had more steps than this, but we couldn't fit them on a slide, so we had to keep it at this. And in actual fact, I got halfway through and then got a bit confused because I thought maybe the reason they were putting all this friction in front of me was because I was accidentally cancelling my car insurance on that day rather than a week in advance, which was when it was due to renew. So I had to start it all over again just to double check I was doing the right thing. I thought, well, if I'm getting confused by it, probably other people are as well. It is probably good to test intentions when cancelling the auto renewal of a car insurance policy, right? You don't want people accidentally driving uninsured. But I really felt like my patience was being tested by this process. I had to confirm my intention and the risks of my intention multiple times with multiple pop-ups and different screens before it actually went through in the end. So by the end, I felt like this probably was a good example of sludge.
Excellent. Thanks, Tim. So I think that is enough examples and enough insight into Tim's personal experiences of financial services. So I will hand back over to James to wrap up the presentation part of today's session.
Okay, thanks very much, Eve. As I said at the outset, we're now going to move into the discussion part of today's webinar. So this is your chance to get involved, to get your own questions answered. Please do put them into the chat or the Q&A, and we'll try and get through as many as we can over the next 30 minutes or so. Eve's going to chair the discussion as usual. So Eve, over to you.
Thank you, James. So we've got a few questions to get us started and also to give people some time to think about what they'd like to ask. So James, first one to you. Modern financial services products are really complicated. So is it possible to get across all the information that you need to during an online application process?
I mean, I think the answer to that has to be no. Particularly with complicated banking and insurance products and investments. I mean, it's hard to think of many where it is. They are so multifaceted. And I think particularly that the less often people claim on them, if they're an insurance product, the less likely they are going to understand them, or the less often they buy them. The less likely they are to have learned from experience. So, for example, you might only buy life insurance once in your life. You might only open a bank account a couple of times in your life. So it's very hard to sort of for consumers to learn as they go. So, of course, financial services providers are always fighting against this. How do we ensure that we use that customer journey, the moment when we know the customer is engaged, to get as much information across as possible? And then it has to become about prioritizing what a lot of your customers don't understand, and what sits outside of their expectations. And that should be feedback that's coming through to you loud and clear in your complaints book, in the feedback that you're getting through your call centres. Over the years, I mean, I've always been amazed, going back to an insurance example, that the number one cause of complaint in home insurance is a misunderstanding around what wear and tear means. Most consumers don't really understand what the line is. And yet, many home insurance journeys don't mention wear and tear anywhere. So, they know that this is something consumers don't understand, but they leave it for them to find out at claim stage. And obviously, all that does is build in a bad experience for a number of consumers. So, trying to think about what is most important. I've got a limited amount of time here. And then, of course, not just using that moment, but following through with emails, at certain key moments in the product life cycle. If you're a bank, and the customer has a mobile app, you should be able to tell when they left the shores of the UK, so you can text them and go, this would be a good time to remind them about the charges for using their card abroad. Trying to sort of find ways to get them timely communications which are more likely to be relevant, but hitting the really big stuff in that journey.
Yeah, brilliant. Thank you, James. And Tim, we talked quite a bit about some of the key planks of behavioural science and how they can help you build clearer customer journeys. But of course, customer behaviours are changing all the time. So how can firms keep on top of that, changing customer behaviours?
Well, I think the first thing to say is that it's about monitoring. It's about monitoring how people behave as they go through your journeys. So how they engage, what actions they end up taking, how long they spend on different screens, and on different decisions, how often they end up flicking back to something, as I did in my auto renewal journey, in order to then go forward again. And having good data on that, good MI, good monitoring, will allow you to see trends. And importantly, you'll be able to see when you change things, what happens. But then the other thing that we always say, bring the behavioural science angle to MI, is that it shouldn't just show the behaviour of the average consumer, if the average consumer really exists in many cases. So the median consumer is not massively of interest in this. It's all about the distribution. It's about those pockets of customers who may be behaving in ways that aren't in line with what you would expect, or maybe making decisions that aren't particularly well informed. So it's those people that rush through a risky journey in a matter of milliseconds and don't engage with things. It's that sort of person. And being able to monitor how many of those people there are and who they are and what outcomes they end up getting is going to be really important. The other thing we would say is it's good to stay on top of industry best practice. So, for example, at the moment, we know that SMS messages can be a very effective way of engaging some consumers. However, as every provider out there gradually adopts the practice of sending more SMS messages because this is effective, presumably SMS messages will just get lost in the noise and they'll become less effective, and we'll move on to the next thing that will help you engage your customers as they go through journeys. So it's about staying on top of those innovations. But obviously, different people will behave differently. Eve, I know you've written an excellent blog on this, which everyone can find on our website. What kind of customers are more at risk of sludges or deceptive patterns or things like that?
Yeah, so there are a range of factors, obviously, that can affect how likely someone will be susceptible to deceptive patterns. And we know from research out there that a person's background can have a big impact on the way they behave online. So one of the themes we see is that social and environmental context is really important. So one of the things we talk about a lot is poor reading ages in adults, and that can be directly linked to lower educational levels. So customers in those groups might be more likely to miss key information if it's not written in a clear and simple way. And a customer's socioeconomic background can also affect them in more practical ways too. So people with lower incomes might be more likely to access websites on mobile phones rather than computers or bigger screens. And again, that smaller screen can mean that they might miss key things if they're not made prominent enough or not laid out well for a mobile screen. The other side, sorry, go ahead, James.
No, you finish your point.
Yeah, well, the other thing I was going to say is we also have behavioural factors. So customers can be more at risk from deceptive patterns or from low friction in a journey simply because they're feeling tired or stressed or have had, a long day at work. They might not pause to reflect before they make a choice. But you also have a group of customers who have less temporary behavioural factors at play. So people with anxiety or those with neurodivergence. So there's a lot of interesting research out there about this and probably too much to cover right now. But yeah, interested to hear your thoughts as well, James.
Yeah, no, I mean, I was just going to say, I mean, I think the points you're making, I suppose, really, cement what Tim was saying, that obviously everybody's individual behaviors are changing. But in terms of, the sort of mean behavior or the average behaviors, they're also always changing. So it just sort of underlines the importance of consumer testing and understanding that ultimately, what is right today won't be right necessarily in 5 years' time. And, I mean, I think if we all think back sort of 10 or 20 years about how our engagement with information has changed, certainly what you only have to go back 15 years or so until none of us had a smartphone. And, that has absolutely radically altered the way that we engage with information. And presumably in another 15 years' time, technology will probably have moved on again. So behavioral science should be something that firms are sort of embedding at the heart of their organization and continually sort of evaluating, and that's the best way to keep on top of it, rather than just sort of saying, well, we took a look at it 5 years ago, so we think it's okay.
Yeah, absolutely. And I think obviously consumer duty will have changed the way that firms need to think about digital journeys. So James, perhaps are there any kind of key things you think should be mentioned here?
Well, I mean, the main thing with consumer duty is that obviously you have to prove that customers are getting good outcomes and that they're understanding your products and the limitations of your products and the communications that are being put in front of them. And so that is obviously a very significant raising of the bar. So, in the past, I think sort of people might have sort of made their best efforts and, not followed through to sort of check, well, what outcomes are we driving here? What we're now starting to see is many firms sort of having a much better grip on monitoring the outcomes and understanding where perhaps the information is driving poor outcomes and how they can change the way that consumers are engaging with that information at different parts of the journey, or indeed, as I mentioned earlier, the product life cycle, through communications at different moments, which which might be able to disseminate information at a time that's more likely to land with a customer. So this isn't a kind of nice to have, nice to do anymore. It's absolutely core to the Consumer Duty, I think. And as we see more firms sort of beginning to change their journeys, learn from those changes, understand how that impacts outcomes, I do think we'll see a sort of gradual rising of the tide, and a rising of the kind of expected bar. So, hopefully what we'll end up with in 5 years, 10 years time is lots more excellent consumer duties journeys that really drive to the heart of helping the customer understand what they're buying and get the very best outcome they can do. Albeit that's always going to be complicated, and there's only so much you can do, and there's going to be some customers that still make bad decisions. But if you can reasonably say, I've done everything within my power to try and deliver good outcomes for the customers, then that's where you need to be as a firm.
Great, and we've had a couple of great questions come in, so please do keep leaving those. I'd like to first go to one left by Jeanette Taylor about the speed of journeys. So Jeanette asks, because of all the regulations we have to abide by for consumers to understand the product at the point of purchase, renewal, etc., the T's and C's, why are we trying to make things quicker for the customer? Is this because of our current lifestyles that we need this done or provided quickly? So Tim, do you want to come in on that question?
I think it's helpful to think about customers as having a sort of a limited time budget, or an unlimited attention budget, and we're working within that when we communicate with customers. And it's no use us complaining that customers don't spend much time thinking about financial services. We sort of just have to work with the reality that they don't find it as interesting as we do. But within that budget, it's about how you engage them. So maybe it's taking the really important stuff slower and the less important stuff more quickly. And you can still have very slick digital journeys which slow people down and really force them to reflect on the key trade-offs that they're making between, say, cover and premium level, as we looked at an example earlier. So it's trying to judge what is the really must-know information and the should-know versus the nice-to-know information. Ultimately, there are markets which have gone down the route over the past 20 years of just making things as quick as possible. Payday loans is an absolutely classic example of where the firms competed on having really slick journeys, and the money would be in your account within minutes. But obviously that wasn't getting across the cost to people, and that's part of the story about how we ended up with Consumer Duty.
Yeah, and I think that we need to use behavioural science to try and sort of help consumers digest more information, because we're fighting an uphill battle. The customer wants to get in and out of that application journey as quickly as possible. And I would say that in the early days of digital journeys, there was often an absolute focus on getting the conversion and getting the customer out the other end. And of course, that tension is still there, because the longer and harder you make your journey for the customer, even if you're doing it in their best interest, the more likely they are to get bored, drop out, not buy the product. And you have to weigh that up against good customer outcomes as well, right? If a customer doesn't buy that life insurance policy they were going to buy because they just get fatigued by the journey, then that's not a good outcome for the customer either necessarily, unless they went off and bought it somewhere else. So we have to try and use that time well, and try and perhaps help customers understand the utility and the benefit to them of carrying on and answering some of these questions. That if they understand that by taking a little bit longer, it's going to deliver them a product that better meets their needs and might save them money, that would give them sort of renewed motivation to carry on with the journey. But I do think we probably are going to need to see the regulator come in some sectors. I mean, I think, comparison sites is an area where, perhaps, there's more that can be done there, and just sort of say, right, this is where we think we need to get to, because there's always that first mover disadvantage. If you start increasing the length of your journey, then initially all you just get is more attrition. And that hits you commercially, and that's not sustainable. So in some really, competitive areas, like it would be helpful if the regulator came in and said, all right, this is what we're expecting from you. And then it sort of gives everybody that permission to move up to the next level.
And in terms of kind of what's expected, particularly in banking. Someone has asked for some examples of best practice in bank purchase journeys. So Tim, do you have any good examples of firms or any advice covering journeys for customers applying for a bank account?
Yeah, normal sort of bank accounts are an interesting one, aren't they? Because there can be loads of jargon, but actually there aren't that many acute customer risks compared to some insurance products or some other retail banking products. Because unless it comes with an overdraft, it doesn't come with credit either. However, there are some really good examples out there. So Starling has some new documents up there going into the terminology that's used in this sort of thing. Nationwide has some good tables with ticks and crosses, making it abundantly clear what you're getting with different accounts. And Triodos does the same thing, actually, in terms of the benefits of a Triodos account and also the limitations as well. And there are loads of these examples all over the market. So things are getting better across the market. We publish blogs on this sort of thing regularly, and you can follow our following of what is best practice.
Yeah, I think that credit card journeys are getting a lot better. I mean, obviously you've got this kind of structural problem in credit journeys where people often sort of don't get that final decision until they've had a hard credit check on their file. And if it's a rejection, then they're lessening the chances of getting accepted by somebody else. But we are seeing more lenders sort of move to being able to give absolute certainty off the back of a soft credit check. And you showed the Capital One example. I mean, they generally don't risk-based price anyway, but if you are that kind of credit card provider that has 3 different APRs for different risk levels and 3 different balance transfer fees and different levels of promotional offers and different credit limits, you really, in an ideal world, want to help the customer understand all of that before they have to actually click, yes, I'm going to have a hard credit check on my file. And we're seeing more people do it now. So, it must be possible, and hopefully the rest of the market will follow suit, and the regulators will continue to bring down the barriers where they're standing in the way of firms doing that.
And James, in terms of helping customers understand other aspects to the product, not just the price. So Becky has asked, the insurance customer journey is often seen as a race to the lowest price, and competitor comparison tables typically focus heavily on the lowest price being the best. So any top tips or good examples of businesses that effectively communicate the importance of quality when choosing insurance?
Yeah, well, look, I mean, it's a topic close to our heart. We do think that all comparison sites can do more in that area. The problem is that these products are complicated, and it sort of goes to the answer I was giving earlier about the tension between attrition and longer journeys. Obviously, most comparison sites have some kind of rating that appears next to products, not necessarily in every channel. And they can be helpful. Sometimes they can be a bit reductive. I don't think that, in the long run, there's any shortcut to better understanding customers' needs. And we're probably going to have to do that by asking more questions. And also, we're going to need to help them understand the trade-offs, because, I may well, answer a bunch of questions saying, I want to have a courtesy car whenever I want it. I want it to be the same size as my own car. I want to be covered for lost and stolen keys. And then I get the results back and the price is, off the charts. So you also need to help people understand, all right, if I take that one off, how much would that save me? And let me think how much that might cost me. If it's a key for my car, hopefully technology can go, just to let you know, the average key for your car costs about £500 to replace. Okay, let me think. Okay, I can probably self-insure for that. But actually a week's courtesy car is going to cost me, a few £1,000s to have the same model and size as I've got. I don't think I can afford that, so I'm going to have to go for that. So I think we're going to have to evolve, comparison, and I'm sure AI can play a key part in that. I think, my guess would be that if we fast forward 5 years, comparison will start to look quite different to the way it looks today.
Absolutely. And actually, Becca has asked, she says, we touched on benchmarking against the industry. Did you say there's a page available with more information on this? Yes. So Becca, we have all of that information in our Insight portal. So please do get in touch after this call and we can walk you through what we've got in there and give you access. So let's take a look at some of the other questions that have come in. We have one here from Lisa talking about legacy systems. I think I'll come to James on this one. So some journeys may be a smokescreen for manual background work, for example, a form for the consumer to complete, which is manually worked in the background and then requires manual actions, which can be in different mediums. So by post, by phone, by email, and can be disjointed. So she says this can be due to legacy systems not connecting. How do we bring these up to standard with funding not being used on legacy systems?
Yeah, I mean, this is a big challenge for many older companies, and I think it's often like the example of sludge that I would always go to first. That insurance journey where you have to download a paper claims form and send it off in the post, and in some cases, I think that it's done with genuine intention to create a bit of sludge in the claims journey. In other cases, it is because there's legacy systems sitting there. I think the regulator takes a proportionate approach to this. Firms need to commit to updating their systems over a period of time. They need to firstly acknowledge where these problems are. Look at the costs of trying to provide an update to that system or migration. And if that's going to cost them a lot of money, it's going to take them a lot of time. Then they should put a roadmap and a plan together. And I think that they'll get a sympathetic hearing from the regulator on it. Consumer Duty is not designed to force everybody to do everything today. But I think you're in the best position if you can sit there and say, we know where the problems are and we've got a plan to sort those out within a reasonable time frame. You can't drag your feet indefinitely. But for most firms, it should be possible in time to migrate those policies over to new systems, or if you've got a reasonably small book and it's going to run off over a relatively short period of time, then you might be able to make the case to the regulator that actually for those customers it's not worth doing the migration. But I don't think firms should be sort of fearful of having that conversation with supervisors and the regulator. Always best to be upfront and acknowledge where there are problems.
Absolutely. And we've had a couple of questions actually coming in on more kind of consumer understanding aspects to journeys. So Tim, interested to hear your thoughts on this one from Jenny. Jenny asks, how can we cater in customer communications for all types of backgrounds, personal situations?
I think we're moving away as a sector from having a single form of communicating towards a model where we allow consumers to change a little bit based on their accessibility requirements, as Eve mentioned earlier. So in 5 years' time, we probably won't have a single version of the T's and C's or a single journey, but there'll be different options you can select depending on your accessibility requirements. That's one thing. But I think ultimately it's about understanding who's in your target market and who is using which journey. So we've done consumer testing on different types of people with characteristics of vulnerability. And it's very hard to generalize across different types of vulnerability because, of course, it's very individual and there's a huge diversity there. But with some journeys, it can be pretty clear what you need to do. So maybe do some consumer testing on the type of people who are going to be making a life insurance claim, for example, right? It's going to be pretty clear what type of vulnerability lots of those people will have, or all of those people will have. And you can really understand what it's going to take to communicate with those guys effectively. And then there are other things you can do as well. So once you've done quite a few tests like that, you can understand, okay, well, people who are going through bereavement tend to prefer this way of communicating. Well, maybe we could incorporate that into our purchase journey because some of those might be going through bereavement as well. And actually, you pick up a lot of information from different types of test, and there's that diminishing marginal returns to more testing, isn't there? As you test tons and tons, you find out actually what people really like when they're being communicated with.
And James, actually, just building on that, Patrick has asked, how can firms strike a right balance between having those important compliance, contractual elements to documents and still ensuring consumer understanding?
Yeah, I don't find that in most sectors the compliance requirements stand in the way of consumer understanding. There are some exceptions to that. I think consumer credit and investments are two areas where there's quite a lot of prescription, an awful lot of jargon, and some of the jargon is actually prescribed by legislation, which is pretty unhelpful. Certainly in the case of consumer credit, there's a review of the Consumer Credit Act going on at the moment. It looks like all the consumer credit rules are going to be passed over to the Financial Conduct Authority, or certainly the disclosure rules, and that'll give them an opportunity to sort of tear up some of the 50-year-old stuff that's being quite unhelpful. But in most cases, it's absolutely possible to simplify documents, even where things are complicated. Of course, there are elements of financial services policies where, it gets challenging because the concepts are quite abstract. I mean, liability is one I often talk about. Just explaining it always feels so abstract to a customer. Particularly if they're reading about a home insurance policy, and you've never even thought about the idea of a window falling off your roof and landing on somebody's head or something like that. So trying to understand, this kind of cover and when it kicks in and use it without jargon is challenging. But if you do ever get to those points where you can't dispatch with something, whether that's because it's a legal term which you feel like you just can't take out of the document because it's got such an important meaning in the courts, or it does happen to be something that sort of is mandated by the regulator, then the backup can always just be provide a plain language explanation after it. Critical illness policies are another interesting one. I mean, the medical definitions in those are really written for doctors. There's no point in trying to get consumers to understand every single medical condition because they're not going to have all of them. So, when we're rewriting critical illness policy for people, we sort of advise them one of two options. One is to just sort of write a kind of intro to the medical definition section at the start of it saying, this is for you to take and be read in conjunction with your doctor, and then, leave the medical jargon as it is. Or if they've got a relatively limited number of conditions, then, have the ABI definition and then have, a plain language one next to it. Although on that point, I do think the ABI could do more to make their definitions a bit more plain language. But that's a whole other debate.
Thanks, James. So yeah, I mean, we've discussed an awful lot today. So Tim, how do firms go about prioritizing this, where they may be resource constrained? Michael asks, what are the biggest bang for buck focus areas?
So I think the first thing to say is that actually a lot of behavioral science isn't necessarily rocket science. A lot of it is quite intuitive, and it's definitely one of those things where you can train your staff quite quickly and easily to have the core fundamentals. And after you've read a couple of books, we can give you some recommendations, and then your staff will be well placed to spot the opportunities for where they can use behavioral science to improve customer outcomes and journeys. So training is really good, doesn't have to be intensive. You don't need to hire a separate behavioral science unit like some of the larger banks and insurers have done. I think the second thing to say is focus on those journeys where you think there might be harm occurring at the moment, and then map them out. It's all about the mapping, really. If your mapping is good, the insights become a lot easier. So pick a purchase journey, potentially, or a claims journey where you think there might be some sludge, and then give it a good mapping, having read some of those books, and see where you end up, and that will get you a long way.
Thanks, Tim. So one final question here for James, perhaps, before we wrap up. We've only got a couple of minutes left, but James, Marcia asks, is there any benchmarking in terms of how much time should an online application for a new product take? She says it'll obviously vary on whether there is a lower or higher potential detriment or risk for the customer, but we also don't want customers to give up the journey. So any thoughts on that one?
Well, I mean, actually, I mean, there isn't, standardized benchmarking for that. There's going to be different consultancies who have run testing and might start to have a view, having worked with different clients like we have. But, as you say, it's going to be different for different product journeys. And I think, the best way for firms to get a grip on, what's the best way to engage with customers is to do their own testing and make tweaks and understand what works. That ultimately the aim of the game is to try and disseminate as much information as possible to customers in the time when they're making that application, without losing them along the way, which is going to hurt you commercially and also may hurt them. So, you should find, using the kind of planks and principles of behavioural science, that you can try and sort of increase knowledge, increase the dissemination of important information to customers through that journey, and then you can test, at the end, are customers understanding that, and make tweaks to try and get those metrics up. And you can focus on the time as well if you want, but I don't think the time is the most important point, really. If you're able to get people to sort of maintain their attention and push through the journey, it doesn't matter if your journey's 1 more minute longer than your competitors. Your most important metrics are probably, attrition rates versus, understanding. So those are the things that I'd say you need to focus on. But yeah, it's I'd say time is probably not the one to focus on, because it could end up driving the wrong outcomes. So focus on the outcomes first, and then see what your testing shows you.
Thanks, James. And I can see Lisa has asked whether we can share the books that Tim referenced in his answer a few minutes ago. So yes, Lisa, we can share those with you after the session today. I think that's just about all we have time for. So yeah, thank you all for your questions, and I'll hand back over to James.
Okay. Yeah. Well, look, thanks very much for joining us today. I'm sorry if we didn't get to your question, but please do feel free to get in touch with us directly if you'd like us to follow up. And as I said at the start, we'll be making the slides available and the recording from today. Bear with us, it normally takes us a day to edit the recording, but that'll be available on our website, and we'll also drop you an email and make the slides available so you can play it back in your own time or share with colleagues. One final plug for our podcast, for those of you who weren't on at the call at the very start. Our first episode went live earlier this month. That's a look forward at what we can expect in financial services regulation and policy across 2025. And we're going to have episode 2 up by the end of this week, where we'll be diving into the current debate around growth versus consumer protection. So I'm sure those of you who are LinkedIn users will have seen the growing commentary around the government's growth agenda, not gross agenda, although some might think it's a gross growth agenda, butting up against consumer protections and calling for deregulation. So we're getting stuck into that in episode 2, and you can listen on Spotify, Apple, or wherever you get your podcasts. We'll be back with another webinar in the spring, but thanks so much for joining us today, and enjoy your lunch. Goodbye for now.